Good afternoon, everybody. My name is Christian Ludwig. I'm Head of Investor Relations at DEUTZ. Today, I would like to give you a quick update over our 9-month results. Before I start, please have a look at our disclaimer. You can find all the important information in the text here closed. Our Q3 or our 9-month results were actually very positive. We had a strong increase in new orders of more than 60%. Our unit sales increased by almost 34%. And also our revenue had a solid growth of 26%. Especially the significant increase in new orders was very positive for us because our order book grew to more than 600 million at the end of the 9-month period. I have to say that we expect around 100 million of the order book is probably due to pre-orders, as some customers brought orders forward due to response to longer lead times and others due to price adjustments. But overall, we had a solid book-to-bill ratio of 1.29, which gives us a very nice visibility into our next fiscal year. And especially important was, of course, that this strong growth and earnings also was visible in our earnings. You can see that our Q3 results actually increased by almost 30 million year over year. With an EBIT margin before one-offs of 3.5%, we're well ahead of our full year guidance of now 2 to 3% for the EBIT margin. After 9 months, we are already in the range that we're targeting with 2.6%. And the positive earnings development is also visible in our cash flow. One of the drivers is the working capital development. Here you can see, despite the strong growth in revenues, due to good management, working capital only increased by 11%. So our working capital ratio actually declined by more than a percentage point to 17%. We had a strong swing in operating cash flow of around about 87 million, and an even slightly bigger swing in the free cash flow due to less investments of 94 million. So after 9 months, we're actually again in positive territory with our free cash flow development. China. After a very solid first half, in the third quarter, we saw a significant slowdown in overall market. We see 3 reasons for this. First of all, the temporary power outages, not only by us, but also by our suppliers and our customers, had a negative effect. Secondly, strict restrictions to contain the spread of corona led to several local lockdowns, which also impacted the supply chain. And thirdly, we are currently experiencing a strong slowdown in the growth of the property market. The problems of Evergreen are just one example for this. This overall led to a collapse in the local truck market. The production planning was reduced by 50% since October of this year. Therefore, we can no longer confirm our sales target for next year of 800 million. We're currently looking closely at the situation, and as soon as we have better visibility, we'll come up with a new number for next year. On the strategic topics, very positive was the progress with our hydrogen strategy. Our 7.8-liter hydrogen engine, which will go into a pilot project with a regional utility company, is progressing as planned. We believe we'll be able to deliver the genset early next year. And we also were able to sign a cooperation agreement with the German Aerospace Center, DLR. Here, we are collaborating on a joint project focused on making construction sites more environmentally friendly. We are looking for development of solutions for running construction site vehicles and agricultural machinery on hydrogen. And also to this end, we announced a new strategic partnership with Blue Will Technologies, a fuel cell company. Blue Will Technologies focuses on fuel cells that run primarily on methanol, which is a renewable liquid fuel. We will invest a 10% stake as soon as the due diligence has been completed, which we expect to be the case in the course of Q4. And this fuel cell technology also is expected to be used for off-highway mobile applications in the future. Finally, I'd quickly like to touch base with our guidance for 2021. As said before, we were able to increase the guidance in September, despite facing still significant issues in our supply chain. We now believe we can sell between 155 and 170,000 DEUTZ engines. This will lead to revenue between 1.6 and 1.7 billion. Our EBIT margin before exceptional items should increase to 2 to 3%, up from 1 to 2%. That should lead to a free cash flow, which should be at least break even. We also confirm our midterm guidance. This remains unchanged at more than 2 billion sales and an adjusted EBIT margin of 7 to 8% by 2023-24. Thank you so much for listening in, and thank you very much, Seat 11A, for having us. Should you have any questions, please contact me. You can see my contact details here via email or by phone. Thank you so much. Goodbye.
Hi there, since you watched this company video until the end, I'm guessing you liked the video. And that's probably because we work very hard to create the most engaging and added value content for you. If you're a company and want to find out how we, at Seat 11A, can make a company video with and about you, please email us at content@seat11a.com.